everyone. My name is Ali Safavi. I'm the CEO and co-founder of Kovu and your host for InsurTech Unscripted. Today, I'm honored to have one of my very good friends, Amir Kabir, general partner at AV8. Obviously, I've known Amir for, I think, almost the beginning of the InsurTech wave, at least the one that really picked up. And we've been friends since. And, he's obviously one of the most knowledgeable investors that I know in the insurance space. And he has a lot of thoughts and theses on where he thinks the space is going. So we're excited to have you on board on the podcast, Amir. Maybe you could tell us a little bit more about yourself before we dive deeper.
Yeah, sure, man. Thanks for having me. Excited to be part of this and talking to you. We have, I know we've known each other, I don't know, maybe for 10 years now. I'm not sure, but maybe a little bit less. But yeah, as you said, since kind of the whole hype cycle of insurance of InsurTech started. But a little bit about myself. I've been investing in the InsurTech space for a little bit over 10 years, and I kind of got into the fintech InsurTech world. Coincidentally, I don't have an insurance background. I come from the tech side. I had operating roles for enterprise startups back in Europe, and when I came to the US, I worked for a venture fund, actually Route 66 Ventures on the East Coast for a while, and got into like very early stage fintech and insurtech deals, and did my first insurtech deal I think in 2013 or so, which was Simple Assurance, and that's how I got into venture. From there, I made my way to the West Coast and helped build up Munich Re Ventures, which I think is very familiar to a lot of people in the insurance world, who are kind of like the first kind of corporate venture VC that dived into insurance pretty heavily and invested in all sorts of InsurTech version ones that people know, like Next Insurance, Insure, HDVI, and so on and so forth. And I joined AV8 Ventures a little bit over 2 years ago as the fourth partner to kind of lead the fintech practice, and have invested so far I think in 7 or 8 companies in the InsurTech world, which is basically built upon the thesis that I have written about the next wave of InsurTech and what I've seen over the last 10 years.
Very cool. So I usually like to start my questioning with what I want, one of the most controversial ideas, but just given the fact that you already have put your thoughts on paper, so so clearly it makes my job a lot easier. So let's start with. I think the way that you looked at InsurTech is interesting. You've looked at it in waves, and you try to compare it to before. So maybe we could start talking a little bit about the history of InsurTech, changes in insurance as an industry, and as it relevant to today, and as we kind of try to think about the future, how the history kind of comes into play.
Yeah, that's a good point. So I started writing about insurance, I think a little bit over 2 years ago. And what I tried to do is in the part one was to kind of trace back the history of insurance or the evolution of InsurTech and see what happened actually the last 100 years, specifically here in the US, when it comes down to insurance and personal insurance and so on and so forth. So when you look at like, the first write up that I did, and the kind of graph that I created, you can see like the big behemoths today, the incumbents like the State Farms and Geico's and Progressive, kind of started in the very early 1900s, right? 1920, 30-ish around. And then the first kind of InsurTech, like the first kind of technological wave in insurance kind of came about within like the 1980s, right? I think 1983 Applied Systems kind of started, 1985 Insurity, Select Quote, 1997, Insurion, and so on and so forth. So these were kind of, and in 2000, like Guidewire. So the 80s, 90s, like kind of defined, I feel, the first kind of wave of technology in insurance. And going forward, when you look at the graph, and what happened is that within the 2000s, a lot of like the first version of InsurTechs, I would say, kind of emerged, which were basically focused on price comparison websites and some sort of like distribution models within insurance, like very rudimentary distribution models. And then in 2010 and onwards to like 2020, that's where I feel like the kind of term InsurTech was kind of minted, let's say, right? They go going into the, you know, and into the crypto world minted. The InsurTech word gets kind of minted because people were basically, comparing like insurance as part of the financial services ecosystem to fintech, and the kind of counter word here was InsurTech. And I think that, emergence of that word InsurTech, coupled with like venture capital money flowing into the ecosystem, started the first wave of InsurTech. And within 2000, 12, 13, 14, 15, obviously the wave of InsurTech took up, and all of the prominent InsurTech companies that are that people know about, as I mentioned before: Next Insurance, Lemonade, Root, Insure, Oscar Health on the health insurance side, Ladder Life, and so on and so forth. They started around that time, and we had some kind of interesting exit scenarios in 2020, 21, where people, the first kind of wave of insurtechs were able to create some sort of a liquidity for early investors. And however, quickly, we saw that like the public markets dismissed somehow what insurtechs had built, and the underlying um, business economics there were not really supporting the way to go public. And so right now I feel like we're entering, InsurTech wave two, and that's like based on the article that I wrote subsequently, where it's about like what have you learned over the last, let's say maybe 10 years when it comes down to really InsurTech, and how can we move forward, and what are the learnings from there that we can apply to the next level of InsurTech, makes sense, if that makes sense.
So let's jump into it. So basically, you're saying that this is the learnings from InsurTech 1.0, and
Hmm.
then based on that, InsurTech 2.0 is created. So on a high level, what are the big learnings that you feel like a lot of investors or entrepreneurs have learned or haven't learned since, or have missed, that you think is worth highlighting? And then
Yeah,
how's that InsurTech 2.0?
I think the biggest kind of learnings or miss was like, hey, technology will, transform insurance, and everything will be better, faster, cheaper, and whatever you want to call it. So obviously tech is part of like insure tech, the same way tech is part of fintech, right? But in both instances I feel, specifically because you are operating in a very regulatory environment, the insurance and the financial services and fintech have to come first. And I think this is the biggest learning here, that technology will not help you win within insurance. No matter how great your technology is, that will not help you win and make big money for you. And I think that was the biggest learning here. However, I think InsurTech Wave One, and again going back to like why technology will not help you win, is that because insurance is not really a top line business. So comparing InsurTech to like a SaaS company, or like an enterprise software company, or even like a consumer company in the commerce world, is completely ill-equipped here, because it's not a top line industry, meaning the more premium you get in, it doesn't mean you're better or doing the better thing. It's more actually a bottom line industry where, the fundamental unit economics have to align, and, the loss ratios play, a very important role, right? So I think this is the biggest learning from my perspective, that, I think people have realized. And then on top of that, I think what people have seen as well, and goes back to the learnings, is that InsurTech Wave One really focused on like the large saturated markets, highly commoditized products like auto insurance, home insurance, renter's insurance. When you look at those products, um, most of them or some of them are mandatory, others are not. But most of the people within, let's just focus on the United States here, have already auto insurance, right? They have homeowners insurance. So it's not that it's an underserved market. So what are you competing here about? You're competing mostly about price, and maybe how do you service customers. So that was kind of the first wave of InsurTech. When you look at them, they were able to quickly acquire customers and show like a top line that people got excited about. However, the underlying the bottom line was not really great here, and over time it was showing. And honestly, if you look at the public markets now, it still shows, right? Those insurtechs that went public, and the numbers are publicly available. You can look at them. It's not that they're making they're profitable businesses. So I think that was the biggest kind of thing here, to focus on like large saturated markets where you basically are just competing about price, right? Because at the end of the day, I have auto insurance from Progressive, and I pay, I think, $140 a month. If I get it for $50 a month, yeah, I'd take it, right? But it doesn't necessarily mean that yeah, you're covering your losses there, and it doesn't necessarily mean that you're getting the right risk as risk profile from a customer perspective, right? And from insurance perspective, those, I think, also the learnings are those who switch quickly or like look for insurance are actually the ones you don't want, right? Um, and so uh, the other thing is also like there was limited differentiation, I feel, in terms of like how in terms of underwriting, meaning what incumbents would do and what insurtechs would do was not much difference. And it goes back to, again, it's a very regulated industry. So meaning like if you do auto insurance, and I've seen a bunch of places there too, they would pitch me like, hey, we don't take FICO into account. We take like other stuffs into account to underwrite you. Well, I'm like, well, that's great, but you can't really do that depending on which state you're in and the regulatory bodies you have to comply with, and you have to like apply for like new products and so on and so forth. So it's a very tough endeavor if you want to really come up with a new product. So from the underwriting perspective, there was also not much differentiation. Some would do more, some would do less. So it was not really that much. Going back to like the products that these insurtechs focused on were very like quote unquote easier products to underwrite, right? So, and obviously, the distribution, I think the learning there is that, customer acquisition is very expensive, and, customer lifetime value, depending on the product, is kind of limited, right? So that means you constantly have to get new customers. And as I said before, if you have to constantly get new customers, you most likely will not get the best risk out there. So I stop here because I think these are like the fundamental things from the learnings perspective, and what InsurTech, Wave One kind of showed for venture investors and the ecosystem. However, I think it's very important to outline that InsurTech Wave One, the companies really navigated like incumbents and service providers, consumers, regulators, and the broader financial market, and showing that, hey, digitization of insurance is inevitable. And it's that's, I think, a very important statement to make, because all the work that went into InsurTech Wave One was very important, although maybe the outcome of some of them, or maybe most of them, was not really great. However, I think there was a lot of learnings that can be applied going forward.
So let me ask you this: like on paper and theory, and again, that's I just want to make sure I kind of get the hypothesis is that if
Hmm.
on paper regulation changes and makes like is less involved with how underwriting is done for a product like auto insurance, are you saying then we'll have truly innovative startups in auto insurance? Like regulation is the main blocker for like a true startup win in a space like auto insurance?
I think so, honestly, because again, you know, um, the way you can go to market is that you take an existing product, right, which a lot of insurtech version ones did, and it's so-called an off-the-shelf product, and you digitize that and distribute it through various channels. And then others took an off-the-shelf product and came up with new kind of innovative underwriting ideas around that, and had to first apply to get that approved from the regulatory bodies, to be able to sell it to the consumer, right? And others, the other way to go about it is also to use ENS paper, and which is not so which is not so scrutinizing on insurance on a regulatory side. But I think that's I mean, it's important that regulatory barriers are there, right? Otherwise everybody would go around and do whatever they want in terms of like writing insurance. So I feel like there's no way to get around it. You have to work with those regulatory entities. But the other learning here too is that it takes a long time to get to market. Some insurtechs took 6 to 9 or 12 months to get a product approved, or a new product approved, or a modified product approved, and then they could go to market, right? So the time to market is very long, and you need to have a long breath if you want to win here.
Very interesting. Okay, and obviously, let's talk a little bit about InsurTech 2.0 before we drill down in some of the areas that I was curious to kind of ask more about. But
Sure.
now, talking about all the learnings from InsurTech 2.0, sorry, 1.0, let's introduce InsurTech 2.0.
So again, this is my kind of 2 cents here, and the stuff that I was thinking about over the last years that I've seen is that in terms of like venture, I always try to ask like, what's the problem here, right? That's I think a fundamental question when you think about venture and venture investing and investing in startups is like, what is the fundamental problem that a startup is trying to solve? And in insurance, going back to like version 1, when you think about it, what was the fundamental problem? And from my perspective, the fundamental problem was that a lot of people, or like the broader community or the consumer, were thinking that there is not much customer centricity in insurance, right? And people were like, hey, insurance companies really don't care about their consumers. That's why their NPS scores is so low, and so on and so forth. And I mean, when you think about like that, insurance companies kind of categorize you and me as policyholders rather than consumers is kind of interesting. It indicates that, right? So that was the fundamental, I feel, problem that people saw and built around that, and try to build like nice apps and plus consumer facing products around insurance, and you can buy quickly. We pay you quickly a claim out, and so on and so forth. And all of this was great, but again, it happened in like, large saturated markets where it was really hard to acquire the good customers, and you were competing against the behemoths that spent like $1 billion on customer acquisition every year. So as a startup, even if you raised a lot of money, it was really hard, and it is really hard to compete against those incumbents. So going now to InsurTech Wave 2, I feel insurance is a very, very big market, obviously, when you look at it. And besides like, home auto renters, there's tons of other insurance products and niche insurance categories where, insurance operates in. Commercial insurance obviously is a big one where I feel there's a lot of opportunity. But other categories that I kind of placed bets on is, for example, collectibles insurance, right? It's a very growing market. The collectibles market is very huge. But if you want to right now go and get your collectibles, let's assume you have a collectibles collection, you have a collection of collectibles of like $1 million. If you call your homeowner's insurance and be like, hey, can I get this, insured under my homeowner's policy? They're most likely say no. And if they say yes, they give you a rider on top of that, which doesn't really cover everything you have. So there's no like really visibility. And some actually want to have a real-time appraisal of your collection. So it's a very cumbersome process to get that. And it goes back to like, what's the problem here is that, hey, if you're like an avid collector, it's really hard for you to get insurance because nobody's really offering, the easy two-way purchase of insurance. So there's actually a problem, and maybe we can build like a new digital insurance product around that, and try to get it to the consumer in various channels. So I think InsurTech Wave 2 focuses on these niche insurance categories that have been, that still to date require a lot of manual, processes or operations. So meaning, you have to fill out like dozens of PDFs. You have to send emails to your agents. The agents comes back and asks 5,000 other questions to you. Then you maybe have to go somewhere to get something appraised before you even get an insurance quote. So all of these, manual processes, I think, in various insurance categories open up the opportunity for InsurTech Wave 2, where technology and digital underwriting really makes sense because as of today, there's not much there, right? And then the other thing here too, InsurTech Wave 2, going back to the learnings, is that if you purely focus on direct to consumer, it's going to be a very tough road. So most of the InsurTechs, I think all of the InsurTechs that I've backed to date, are basically mostly focused on B2B2C. So going through partners and partner channels to distribute your product is way more lucrative. And I think that was also, again, a learning of InsurTech Wave 1, because all of the InsurTech Wave 1s kind of started direct to consumer and then quickly realized, oh man, it's hard. So maybe we should, talk to some partners or agents or agencies and see how they can distribute our products.
Very interesting. So let me ask you a few questions more specifically now in terms of how you're seeing the future. Number one is when we talk about niche product sets, the idea of it is great, right? But at the same time, we want to make sure we're going after ideas that are big enough markets. One
Sure.
big learning I've had is that a lot of markets, the reason, because to me, insurance industry has been one of the best industries when it comes to sales. It's an industry that's
Hmm.
been built around sales. And products like, let's say, disability insurance, the reason that is not as big as life insurance is because it's just harder to sell. And just having a startup doesn't justify like a market. And again, for me, maybe like I don't even see disability as a niche market, but I'm saying for a market opportunity is much smaller. How many markets do you think are out there for insurance that are large enough markets that are VC backable and require true digital innovation versus just a company with an underwriting model that is not really like a software company?
Yeah, absolutely. It's a very great question. So when I kind of started in insurtech world or investing world, I always was like, hey, if if a startup can have $1 billion outcome and you as a venture investor have 10%, and again, I'm speaking about like seed stage investing and funds that are smaller than $200 million, right? Not like the big behemoths that have raised $5 billion. If you have $1 billion outcome and someone owns 10%, man, you kind of either returned your fund or you kind of returned half of your fund, which is amazing. So if you have a couple of those, that's great. Um, but obviously, when you look at these niche markets, most of them are maybe $10 billion, some of them are $20 billion. But the good thing here is, compared to like the $80 billion market in home insurance, the way I look at it is like, if you operate in this $20 billion market where nobody really has technology, where nobody is really trying to innovate on the product side, where incumbents are still doing their thing and things are working, and actually in some of those markets, some of those markets are very underserved as well, meaning customers want insurance but they can't get it, or it's hard to get for them. If you can get like 10% of that market or 20% of that market, which would be $2 to $4 billion, and the outcome of your startup could be around that, it's way more lucrative than going for like the 80 billion, $90 billion market, which is highly saturated. Like incumbents are basically dominating it. There's nobody's underserved there. Like maybe a very tiny percentage of consumers cannot get insurance, and your digital product will not really make that big of a difference, because going to State Farm and getting your home insurance will take maybe 2 hours or maybe a day, and then getting your home insurance to an app might take 3 minutes. It doesn't make really that much of a difference because the price will not make a difference. So you invest in companies that are going for these markets and have 10%, maybe 15% ownership, and that company exits for like a billion, 2 billion. I have a great outcome, and that's totally fine for me, right? I think, going back to your question, and this is always this has been kind of something that went through my mind, or I was thinking about a lot, and maybe people will challenge me on that. I feel like there's no way to have a $50 billion exit like a Databricks or whatever you want to call it, Snowflake, whatever, all of these SaaS enterprise software companies that exit for a huge amount of money. I don't feel we will see any $50 billion InsureTech outcome. I mean, I would be surprised because think about it. Look at like going back to the incumbents, right? I mean, look at Progressive, Geico, State Farm, whatever. Their book of business, I think they're writing whatever, $40 billion in premium, 50 billion, very diversified book of business, right? They have home, auto renters, and all sorts of like other stuff. Um, what's their market value? What's their market cap? I would say it's
1 to 1 or 1 to 2. Depends on
yeah,
how good the book is. Like I'm booked.
correct, correct, yeah, yeah.
So
So one thing, one other, I think, kind of, and it goes back to like the version one and like the niche kind of businesses, right? I think the best kind of comparison here is Kinsale. Have you heard about Kinsale Capital Group, right? I mean, they're kind of focused very much on like the, you know, niche commercial market and specialized insurance. And their market cap right now is at around $7.6 billion. So I think,
but that is
that
large commercial risk, right? Like that is large commercial niche risk.
correct, but still
Yeah.
niche and specialized, right? So
Because only the reason I'm saying that is because to me that's not a tech outcome as much as it is because maybe it's
the
like
tech out here's the thing, that goes back to like insurance has to play a fundamental role and tech will enable it, right? So you can't be like, oh, I'm InsureTech and I want to be. That was another thing, like people valued these companies at, you know, tech companies comparables and SaaS companies. I don't think you can do that. So that's why, if you specifically operate in the so-called challenger world of InsureTech, meaning those who go after risk, after product and distribution, the first thing that matters there is the insurance fundamentals. The second thing is like the book of business that you're valued on and how profitable it is. And I think third is that if you have a lot of good technology that enables you to have this good book of business because you're better in underwriting, then you can be like, hey, this is the added value I have, right? But just saying, hey, because I have digital underwriting, I have a great app, and I distribute this product. That's why I'm a tech company in insurance or InsureTech. I feel like that's hard to justify.
there's definitely a line or there's no line maybe. I think that's another point which between where's a company called a startup and what is a company just called a company that is like small business.
Sure.
Because if we're talking about very large commercial niche, these are usually capital plays, right? Like companies that like the one they mentioned are typically companies that are backed by like a huge balance sheet or like by big PE that are just taking very large risks, and they usually pride themselves in their underwriting skills to be able to like take on those risks when other people can't. Go to a Lloyd's
Yeah.
credit center or whatever that is. The idea here, from what I understand, is that these companies that have always existed, if they use more technology in their underwriting, we think it might give them an edge to better underwrite these one-off risks. But these one-off risks, in a lot of cases, are not repeatable businesses. These are like one-off risks, like a Lloyd model, right? If we're talking about repeatable risks that you could create a better AI engine that on very repeatable, it keeps doing it, then I wonder how many markets are like that are out there to say like we're going to create like a better insurance for X, and it's a market that customers are looking for it, not a market they have to push it down their throat, and it's a large enough market. I just don't know how many are there unless we just go for like these niche applications that are like I'm just going to set up a capital group and use technology to better underwrite every individual risk that comes to my door.
I mean, that goes back to like also when you look at the article I wrote, the next wave. I think what you're saying touches base on what I think is like the opportunity in embedded insurance, right? This is like a kind of has been a hot topic for quite some years, and I feel the embedded technology can enable a bigger outcome here if you have the right tool sets, because if you have kind of an embedded play, and you're able to um, get a ton of like input from a data perspective and underwrite better, you can maybe you know um, win also in those kind of flow businesses, right? The home auto renters, and kind of have a bigger outcome there. Um, But I feel like honestly, like, I know that venture investors and we ourselves too, obviously, we always want the bigger, markets. But I give you an example. RPA, right? Robotic process automation. 6, 7 years ago, when I looked into that, the market size was 5 billion. I mean, now look at UiPath, right? I mean, and so I think in every like startup that had a big outcome, even Uber, right? Look at Uber. I mean, they started as a black car business in San Francisco where the market size was 100 million. And if you would have said, okay, this is it, right? I mean, that would be a hard outcome to justify. But eventually, they kind of went into different kind of categories around transportation. And I think it's the same case here with those niche insurance businesses, right? As an example, I invested in Covertree. They're focusing on home insurance for manufactured homes, right? And it's a complete, like, it's a different kind of underwriting there, different risk. The market size, if you look at that from the premium perspective, just for manufactured homes, is around 10 billion a year, right? Which I think is still great. But which is great here, there is a lot of like adjacent other insurance categories that fall into place that you can, play in as well if you're Covertree, right? Because if you look at the demographic that lives in manufactured homes, most of them have an RV, most of them have a motorbike, some of them have a boat, right? So if you look at those kind of three sectors in total with like manufactured homes, you basically are now at around, I think, 50 billion in market size, right? So that's, I think, where you can play, and where if you win one category and you can apply your technology, your underwriting, whatever you have into others, and your distribution, you can make a bigger outcome.
So that's a good example. A $10 billion market, if a company set up as an MGA and doesn't carry risk, that means they probably are taking their revenue will be around 20% of it or less.
It depends. 20 to 30 depends on how you know
Yeah.
what they negotiate.
Point is like then the market size is only 2 or 3 billion from a revenue perspective, unless they carry the full risk. So we're talking about $2 or $3 billion in entire market if they captured the total market. And but then you have to really bet or prove that you could sell adjacent markets to those customers, which goes back to the initial problem that I see, which is a lot of people already have auto insurance, and then
Yeah.
getting them to move over the things that they already have is going to be hard. That's why I keep wondering like how many big opportunities are out there. On paper, I mean it's indefinite because you could always create a better company, but as you said, it's very hard to move people from their incumbent carriers.
Yeah.
Um,
And so going back to this, I think, yes, if you just look at it from the MGA perspective, I think it will be really, really hard to IPO an MGA, right? So the intermediate outcome would be here that an incumbent that is already servicing in that space comes and buys the startup because it sees the technology and can plug it into their ecosystem,
for a
right?
few hundred
And
million.
yeah, exactly. The outcome will probably not be in the billions, but maybe in the upper 100 millions and more. But I think from my perspective and the companies that I bet on, my goal is with these companies, if it works out on the MGA side, and we've seen it in the version 1, 2, most of them become risk-bearing entities, right, and become eventually carriers of some sort and can take risk themselves.
I
And
think
so
that's
that's
what
where
I'm pushing for. You think that should be part of the InsurTech roadmap?
and only I feel if you have figured it out. And I think that was also, I feel, a learning from version 1. A lot of these insurtechs might have pivoted quickly to become a carrier, or even started out as a carrier. I mean, look at Root, right? I mean, they started as a carrier, and I mean, if you look at the market size and market cap, I mean, the outcome was not great. Like, sure, they went public for whatever 6 billion, but I mean, if you look at it right now, the market value is less than 100, I think. So I feel like you can only become a carrier if you gradually move into that, right? Because again, why do you become a carrier? Is that, hey, I I have the data, I have the underwriting skills, and I've you know operated into that market, so I know what good risks look like, and that's why I want to take risk myself, rather than like, hey, I want to start as a carrier. I think I know what underwriting works looks like. I have this great data set, and let me do it, right? So, um, I have another company I invested in, which is actually a full stack carrier, right? They're a full stack carrier operating in the Latin American market and selling life insurance. The reason there why I was excited and I think that's the best way to go is because the team has done this twice before. They had the data, they had the learnings from the way they did it before, and so for them it makes the most sense to do that. And again, Latin America is very different too in terms of the market. So they're the first kind of digital life insurance product that exists more or less in the Latin American market, and they distribute it through agents and agencies and brokerages rather than like going direct to consumer.
I think a part of the thesis that I'm very much agreeing with you on is that you can't. I think the big learning I agree, which is as an investor, I learned the hard way, and then as an operator also again, you can't just go to a market that exists and compete with auto insurance and say I'm just digital, so I'm better, because just being digital is not value on its own, apart from
No.
answering the why, and the whys are typically not the right whys when people pitch them. So I'm there with you. I think if we're truly to innovate, we'll probably have to innovate on distribution, or you have to innovate on underwriting, just being more profitable. Or one thing that is becoming a bigger thing, which I saw in your notes as well, which is around risk management. So how do we create like a complete solution that manages risk as opposed to just selling insurance? Like cyber is a good example where we have cybersecurity and risk and all that.
Yeah.
Tell me how you think about the risk management component as part of like the future MGA route or future of insurance as a whole.
Yeah, again, I mean that also depends on like what market you're operating in, right? I think cyber is a good example where risk management is a big component of that. And I mean, I think IoT was kind of like the forerunner here, where you would use sensor data to risk mitigate and then also do insurance. And one market actually going back to InsurTech Wave 2, which I also mentioned in my article, is medical malpractice, right? Medical malpractice, an old market, highly unprofitable. If you look at all the carriers there's only one or two carriers that are really doing good risk, or maybe like a handful, and the rest is just like losing entities. And again, nobody there, or like very few players, have some sort of a technological advantage. And the market there also, I think, medical malpractice is around 15 billion, which includes physicians, physician assistants, nurses, and like big hospitals. It's around 15 billion. But going back to risk management, I think you can apply a lot of technology there to analyze how risk or assess risk within like physicians' offices or hospitals, and therefore be able to provide better insurance or mitigate claims, right? So it really depends, I think, on the market when you think about risk management associated with that. I mean, on the personal side, as you probably know as well, having these dongles in the cars and like data around the car is kind of like the risk management component as well. But interesting enough, I don't know if you saw that today. I was reading about that. Uh, Tesla is obviously like in the forefront here with selling insurance to their customers, and basically saying, hey, given that we have all the data, we have like real time visibility in the computer that you're driving, we can give you better insurance. But here, apparently, there's still a lot of learnings to do, because a couple of customers are suing actually Tesla, because their Tesla kind of like wrongfully uh, assessed the data around their driving behavior, basically inflated car insurance premiums based on misleading collision warnings and not actual driving behavior, right? So
Yeah.
that's kind of
A
interesting.
new liability
So
that they hadn't thought about. No,
yeah,
yeah. So, last thing that I'm also really curious, going to hear your thoughts on is what about all this LLM AI stuff? What are you excited about? Do you feel like they're going to make a big change, and which areas do you think they're going to have the most amount of impact on?
yeah. I think like I mean, AI is first of all nothing new, right? I mean, it has been around for decades. I think what kind of now changed a lot of things is ChatGPT, and I think that's where like everybody's like, oh my god, like there's so much opportunity here because like we finally can talk to a computer and we get like real time answers. I think from the insurance perspective, and again, as I outlined also in my article, there's so many other problems that we have to solve first that now saying that AI and ML will solve this all for us is kind of far-fetched, right? I mean, where this technology can play a role, I think, is definitely on the claims side, right? On the claims part, I feel AI and ML and data can play a huge role in streamlining the claims process and making it more smooth. Which again, if you do that, you will have better and more satisfied customers, and so you will have better retention when it comes down to customers. But in terms of like the sales process, you can probably embed some AI and ML there too. But again, learning, I think, from version one was as well that depending on which market you operate in, and the higher the premium volume is, the higher the likelihood that someone wants to talk to someone, right? So fully digitalizing an insurance process and the sale and servicing and then the aftermath, I think is maybe doable and very easily insurable risk, right? But not like in the risk categories that are associated with like bigger premiums.
And last question for you: if you were to start a company today in insurance, what company would you start, or what idea would you run with?
Again, I'm very much interested in products and distribution and how you can better create an insurance product for a specific market, right? Because most of these products have been old or like have been around for a long time, and I've looked in depth into medical malpractice, and I feel like that's a very very interesting space, and where there's a lot of opportunity. And there's actually one company that is doing exactly what I was thinking of doing, and hopefully they're successful, and hopefully maybe I can be part of that from a venture perspective.
Cool. Well, Amir, I took a lot of your time. I appreciate you being on the podcast, and
thanks, man. That was good. I appreciate it.
Thanks for listening, and enjoy the rest of your day.
Thanks so much. Thanks for having me. Talk to you soon.